So this is the 2020 Future is Now part of this meeting. We have panelists in 3 different locations. We have panelists in our virtual world of Zoom. We've got a panelist here in our physical space in Vancouver. We've got a panelist in our physical space in Edmonton, and we're all tethered together. So this is a, as far as I know, this is the first time anybody has tried anything this ridiculous.
Hi, Dave.
So we've got Ralph Case, one of the most legendary, a man that almost needs no introduction, but there's a lot of people tuned into this meeting who might not know you, Ralph. So allow me to introduce the man, the myth, the legend, one of the most well-known and successful Vancouver real estate investors, basically of all time. Ralph was a founding member of REAG. He's done tons of different development projects all over the Canada and the United States. And it just seems like every deal you do is a winner. I don't know how you do it, but we're here to get Ralph's perspective on what the right moves are going to be heading into 2020. Adrian, over to you.
Awesome. So I have Tyler Uzelman here. He is the founder of Libertas Property Management. He is on our power team. And so he's our source of information when it comes to what the heck is going on in property management, what's going on with tenants. And yeah, we're super excited to have him here and talk a little bit about his experience, what's going on in the market.
Amazing. And we've got Keaton. Keaton, allow me to introduce. So Keaton is being a very responsible young man. He was exposed to an individual who had a COVID concern and wisely has chosen to broadcast from home. So Keaton, I applaud you playing by the rules and keeping everybody COVID safe. Keaton is one of the top mortgage brokers in Western Canada. He does all the mortgages for our team, and he's bringing the mortgage perspective to the table. Our final panelist, Mr. Dave Dubois himself. Dave is one of the biggest thought leaders in the joint venture space in Western Canada. He coaches some of the top real estate investors. He knows a lot about what's going on, and his finger's on the pulse of the market because he interacts with the people who are moving and shaking and doing deals right now. Dave, just a heads up, you're currently on mute, so we'll get you unmuted there. And so we wanted to bring a diverse array of perspectives to the table. We want to know what's going on in the rental market. We want to know what's going on from the perspective of an investor who's got their finger on the pulse of the market. We've got Keaton here to talk mortgages. We've got Dave here to talk about what's happening on the streets and where the opportunities lie. So gentlemen, I'm going to be moderating the panel here from Vancouver, and we'll get you all to chime in turn. I'll try to direct the flow of traffic just so that we're not stumbling over each other. But I'm gonna put the first question out there that I think applies to all of us, and I want each of your unique perspectives. And the question is, now that we're seeing mortgage deferrals start to end, we're seeing government supply of supports drying up, what are you anticipating for the next 6 months for part 2 of COVID, now that the first chapter is on its way out? And Ralph, we'll start with you because we're here in Vancouver.
Okay. So it's great to see all these people here. My wife, as I left the house, said, why don't you just do it on Zoom? And I said, I haven't seen real estate investors since February. So this is awesome. Yay. But I'm, how should I phrase this? I'm a little bit cautious with COVID phase 2 because it could be horrible. It could be more of the same, or it could be not as bad as everybody's saying it's going to be. So I'm always, because of my age, I'm more risk averse than younger people, because younger people, you can get wiped out, you can survive. So my theory is when you're over 60, you want to, just not take risks. So I had a couple of unsolicited offers come along my way in the last couple of weeks, and I took them because they were high offers, and I want to be in some cash. But I also closed on a building with James 2 weeks ago, 24-unit building in Edmonton, where we're getting an interest rate of like 1.65%. So it's a world that's on a deal-by-deal basis. So they're good deals. I just closed on a 17-unit building in Sarnia 2 weeks ago, where I got vendor financing. It's about $200,000 less than the building I own next door. Like the price is incredible, and the rents have about $150 a month each suite to move up. So all I have to do is bring the rents to market rent, and at a like 5.5, 6 cap, which I bought it at, it'll go up in value of $300,000 without the market going up. So I like that multiplier effect, buy deals where I can manipulate them, whether the market goes up, market goes down, But the bottom line is, in this market, I highly recommend you have at least 6 to 12 months of cash in the bank in case shit hits the fan.
I definitely think that's a great tip, and it's a good conservative approach. The other nice thing about having cash in the bank is that if that once in a lifetime deal comes along, then you have the big stack, and you can make a move with it.
Yeah. And then, like, today is September 30th, and Revenue Canada came knocking. It's nice to have cash when they say, "Oh, you owe a check."
That's definitely true.
And I was trying to look at a positive spin and like, okay, when you write a check like this, it means you're doing well. So just shut up. So.
Well, I always say the same thing. I'd rather pay tax on money I'm making than zero tax and make $0.
Exactly. Like, oh yeah, there's the Donald, the $750.
Yeah, exactly.
the business genius. How can you lose 79 million or 790 million?
Oh,
yeah,
it's insane. So Dave, let's get your take on it. What are you seeing heading into what we've coined in this meeting as COVID phase 2? You know, the real milestone event being, supports are ending, mortgage deferrals are ending. We're heading into the next chapter. What are you seeing heading into winter?
Well, first things, James, thanks for having me here. Second thing is my crystal ball sucks. When this whole COVID thing started, I figured it was going to be death and mayhem and all sorts of terrible things happening. And what I didn't take into account was the government printing a bunch more money and keeping everybody afloat. And I'm not sure how accurate it is, but I was watching on CBC that the dollars that they've pumped into wage subsidies through COVID, they've replaced whatever wages would have been lost with 1.52 times the money that would have been lost with these subsidies and whatnot. So they've actually put a lot more money into the economy than would have naturally fallen out otherwise. So I didn't take that into account. I didn't see, I thought there's going to be a lot more motivated sellers. There's going to be a lot more opportunity in real estate than there has been as far as deals go. Now, COVID part 2, I don't know. We're talking about the government subsidies drying up. It doesn't seem like they're going to dry up anytime soon. They're replacing stuff. They're adding different twists to unemployment insurance. They're doing all this kind of stuff. So I think the government's going to keep printing money and propping up the economy for quite some time. So I don't know exactly short term what kind of effect that's going to have on the real estate market, but I think long term there definitely are going to be opportunities out there. And the clients that I'm working with right now have not slowed down whatsoever, just like you guys are all talking about. I mean, Ralph is going to town. James, you're going to town. You're buying stuff left, right, and center. There's opportunities out there. And I think people right now, if you position it properly, are open to looking at real estate as an option. I mean, if we look back, we see what's going on with the stock market, especially at the beginning of the whole COVID thing. I mean, there was an amazing crash in a very, very short period of time. It's rebounded up. It's up, down, all over the place. I think now is a good time to kind of point out all of the pros that come along with a well-chosen real estate investment. Now is a good time to get your investors lined up, primed, ready to go. So when you do come across an opportunity, just like Ralph's talking about, you got the capital there to actually act on it. So yeah, my most successful clients, they're out rocking and rolling, raising capital and doing deals left, right, and center.
I love it. Now, Tyler, what are you seeing from the perspective of a property manager and landlord? And obviously, you're the guy in Edmonton. You've got over a 400 door portfolio of units that you manage. What are you guys prepping for? What are you seeing heading into this winter and this phase 2 of COVID?
Well, I'm going to have to say that I think my crystal ball is the same. It sort of sucks as well. I know when it first started, we were worried about Alberta instituted a thing about you can't kick a tenant out for not paying their rent. I think we had 6 tenants out of 400 that had to make arrangements on their rent. It wasn't that big of a deal. It wasn't as big of a deal as we thought it was going to be. With things running out, one of our concerns right now is the tax complications that are going to come this coming year. You have some people that are unserved. They may have been paid, up to $14,000 without paying tax on it. But come tax season, they're going to have a tax bill of $4,000 or $5,000. And if they were living paycheck to paycheck, that's going to impact their ability to pay their rent down the road. So one of the things that we're doing when we're looking at applications is, where are you on serve? How much did you get? How are you actually planning to pay the tax down the road? And if they've got good answers for that, that's definitely a check in the right direction. Rental wise, things really haven't slowed down. Things are still moving quite a bit. We probably get about, I'd say 80 to 100 inquiries a day for rentals. People are showing up, but there's a lot on the market. So they'll show up, they'll see your place, but then they'll see 4 other places at the same time. So one of the things that you have to do when you're showing the properties, you have to really be aggressive, and not aggressive, I should say assertive, to, what would it take for you to rent this place in order to fill a vacancy? Because you're competing against a lot of other landlords that are, there's going to be a lot of accidental landlords because they can't sell their places and they're coming into the winter season, so they're going to look to rent it. So you're going to have a little bit more of a surplus on the market. So, but hopefully the weather holds out and it doesn't get to minus 30 quickly, and we can keep renting some property there.
And Tyler, just to keep talking about what we're dealing with right now, I know that in the heat of COVID, we did a lot of virtual showings. We, get your phone out, do the video tour, and so on and so forth. How much of that is prevalent versus people just being willing to show up and use personal protective equipment as you're filling vacancies?
I don't think it's impacted it that much. I think the biggest issue is current tenants that gave notice don't want people going through their property. But as long as you can reassure them that everybody's wearing a mask, you have hand sanitizer, you're only taking in one set of potential tenants at a time, you can alleviate those fears. There's a very small percentage that actually will not allow you into the property. But for people showing up, I don't really think it's impacted that much. I think here in Alberta anyway, I think it's almost business as usual, except you're wearing a face mask.
Awesome. And Keaton, I'm definitely curious to hear your perspective, because right now interest rates are unbelievably low. And what are you observing heading into this phase 2 of COVID from the mortgage market?
It's been relatively interesting. The interesting thing to keep in mind is that the better the economy does, the higher rates will go typically. So when we're in a situation like this where things are uncertain or they're going downhill potentially, rates will drop. So there's been this kind of offset pressure as there's, the economy slowed down, COVID's happened, that has caused rates to drop. That has then caused an increase in demand or desire for buying real estate, because effectively you can own property for less by the fact that your payments are lower. So that's kind of pushed things upward. And we've all, I think, really shared and experienced that the market has picked up. We're busier than we've ever been. So it's been an interesting one, a little bit of a wild ride with the lender policies and dealing with, potentially people having employment changes. The lenders have adapted their policies, appraisals are done differently, but overall everything's adapted and everything's moving forward. It's busy. So the interesting
awesome.
one for me has been with the mortgage deferrals. If people deferred in March, April, their deferrals are running out now. So someone who deferred in April's first payment will be due sometime in October. Now, if a percentage of these people that deferred are going to be in financial trouble, it's going to take usually 2 to 3 months of missed payments before foreclosure starts. Then it'll take about 30 days for court to process, and then the clients will have 6 months to essentially sell their home before the foreclosure process really, really takes hold and they start to hit the market. So I think it's going to be really interesting for investors. There's going to be more and more opportunities popping up along the way where the people that are going to get into trouble, it's a very gradual process. And I think it's what protects the market. But for the active investors or realtors that specialize in this stuff, or property managers, they're having these conversations with owners on a regular basis. I think there's going to be a lot of off-market deals that we're going to see, potentials for agreement for sale. And I think that it's going to be a relatively gradual transition as these people realize they're in trouble, whether it's through credit cards or mortgage payments, employment's changed, income's changed. So I think that's where, you know, it's going to be very interesting to see who finds these deals. And I think the success or failure people find is really going to depend on their outlook and if they're looking or not.
Well, I think that's a great segue into the next question I want to start batting around. So we've talked a little bit about what you guys are seeing, what you've seen in the market, what your forecasts are. But the real question we always have as investors is what do I do about it? You know, what actions make sense? What strategies should I keep in mind? And where do the opportunities lie? So I'm going to mix up the order just a little bit. Dave, we'll start with you. What's action time? What are we doing? What are the best moves to be making as an investor? And what are the opportunities we're keeping an eye out for?
Well, I agree with Keaton. I think there's going to be a lot of opportunity for dealing directly with home sellers that are, or homeowners that are getting into trouble. So there's all sorts of different options there. You can be looking at agreements for sale. You can be looking at getting options on their properties. You can be looking at taking over the deed, so to speak, as they say it down in the States. You can be looking at doing sandwich leases. Basically, whatever kind of solves their problem, takes that big 900-pound financial grill off their back and gives them some sort of hope for holding on to their semblance of a credit score. That can be a really good opportunity there. So what's involved with that? It's a matter of cranking up your marketing to attract motivated home sellers before they get too far down the line, before they get into month 5 of that foreclosure process, right? If you can reach out to them, if you can get them to put up their hand and start having that conversation when they're just starting to get the first niggles and nasty letters from the bank, that's where you want to be getting in on.
And Ralph, you're already snagging some of these opportunities. So what's on your radar? I mean, you have such a great history of identifying and grabbing really great deals. So, I mean, I'm sure you've been through markets like this before. What's the move? What's the strategy?
My strategy, which I started doing in about 2010, because up till that time I was doing a lot of flipping of apartment buildings and syndications, is I just started picking buildings that I wanted to own forever. And I didn't care what they sold for. I thought they were a great deal. I could do the multiplier effect. I could increase the net operating income and get a nice gain. But, you know, basically the strategy of hold it forever. And I think right now we're in a market where the governments are printing money in an unprecedented way. And what happens when governments print money is we have inflation. So yes, there could be some stormy waters with some mortgages, but I think the vast majority of people, you know, you go out on the highway and you look at all these commuters, like a lot of these commuters have stable jobs and they're not worried about their mortgage. Probably, if I were to guess a percentage, I'd say 90%. So we're looking at 10% might be in trouble with mortgages. That's just like a little blip. I think what we want to do is get in the market if it's a good deal, and like just keep your radar out for good deals. My son moved to Seattle last year, and we've been trying to buy a house in Seattle since February of this year. 7 offers, all the time there was at least 3, sometimes 8 offers competing, never less than 3. We always came in second place until about 3 weeks ago when we got one. And luckily, this owner, you know, looked at them on an offer by offer basis rather than waiting for a group of people to come in and compete against one another. So we were able to get subject to financing, subject to inspection. Like, don't go out there and buy stuff silly without inspection and a financing clause. But they're deals. And it turned out that this one that we tied up, it's a house on half an acre of land that can be subdivided, $535,000. And it's like 4 miles from, you know, all these high-tech businesses. Like, he's a mechanical engineer. It's 4 miles from his work. It's near Boeing. Like there's so many jobs down there. I look at markets where there's growth. Like Edmonton, I think is a market because it's been hit and it's going to come back. Like we're going to keep, burning oil. Edmonton is a nice stable market where you can buy a 6% cap and get a 1.6 mortgage. Like that just makes me want to dance on the table. Seattle, I could get a 30-year mortgage at 2% on a $535,000, 1,800 square foot house we can put a suite in for like 10 grand, and it's subdividable. It's half an acre, and it's like 4 miles from, north, University of Washington. It's like incredible. Like it's close to the ocean. So there are deals out there. I got an unsolicited offer on a property that I did in Phoenix. We made several $100,000 because it seemed like a really high offer. We took it and it went firm last week. But there's another offer around the corner or another deal. Like there's deals everywhere. So just keep your radar. I'm probably gonna end up spending the money again because this deal is like, as long as you have good market knowledge, you're gonna find deals. And that's why I totally believe you gotta specify in areas. Like don't look everywhere. Like pick a couple of areas and just become a specialist. That's how I got a great deal in Sarnia, because I've bought 10 houses and 3 apartment buildings. Like I know the market backwards and forwards. But you ask me about Guelph or you ask me about Kingston, like I know nothing. I'd have to go in there and start all over. So I just pick an area where I'm the expert. Phoenix, I'm the expert. Edmonton, James is the expert. So when he tells me this is a great deal, I rely on James because we have a really good relationship. I know this guy knows what he's doing. And I said, okay, I'll write a check. What the hell? Otherwise it sits in the bank and doesn't make any money. Other than my liquidity fund. You got to have that liquidity fund. And when I say liquidity, I mean not 6 months of cash flow. I mean 6 months of gross expenses. So if you have a mortgage payment, an insurance payment, property management, all this stuff, like have enough money to pay that for 6 months to 12 months because things could go haywire, but they're not going to go haywire for long. Usually when they do, they like Dave was saying with the stock market, it jumps down and then it comes back up. But long term, I'm very bullish. Government's printing money. Inflation, real estate's going to go up, and just buy it like you want to own it forever. Has good cash flow, and ka-ching, ka-ching, ka-ching. Sorry, I spoke so long.
No, you know what? I'm gonna play with your question there and do a follow up because I think you make a great point of like you're looking at properties under the lens of you want to own it forever. So
as opposed to flippers, I think flippers get really burned in a market like this.
Yeah. So what are some criteria that make a property one that you'd want to own forever? Like what's
6% cap rate means if it was free and clear, it gives a 6% return. Like so you buy a building for $1 million, it gives you $60,000 a year. Now if you buy that building at a 6% return and your interest rate is 1.6, that's a pretty damn good cash flow. And plus it has upside of rent. So that's the type thing I look for is, number one, if the rents can't be changed, you have to have a differential between what the cap rate is and what your interest rate and your expenses are going to be. But, number two is something where I go in like I did in Sarnia and I'm buying a building, the exact same cookie cutter building. It was built by the same guy 30 years ago. And he did a great job because we've owned our building for a year and it's a beautiful building. So the one next door comes up, mirror image, and it's $150 a month less per suite on 17 suites. And once we just increase those to market, it might take 5 years. I don't know, but that's $350,000 built in just getting it to market. Not to mention, rents going up or, good stuff, which I think is going to happen in Ontario. So look for an owner asleep at the wheel, or look for a market that's asleep at the wheel. Maybe Edmonton, you'd say the market is asleep at the wheel. Sooner or later, it'll wake up. Sarnia is hotter than a firecracker. Seattle's hotter than a firecracker. Phoenix is hotter than a firecracker. Prince George is pretty active. Vancouver is hotter than a firecracker from what I hear. And I've bought a building on East Hastings Street with some partners that we're doing very, very well on. So I'm diversified.
I like it.
And I'll own them all forever if I have to.
Well, that's going to be a good segue into a question for Tyler. Because from a property manager's perspective, we're talking about making good choices because, especially in a market like this, we want stability, we want good tenants, and part of that is just attracting good tenants. So, when we're talking about the move heading into the next phase of COVID, Tyler, like, what are we doing to hold on to good tenants, and what are we doing to attract good tenants in a market like this?
I think when you get a good tenant, you want to try to hold on to them as much as you can. And I think that's in any market, but in this COVID era, definitely. One of the things that you can do, you know, I've said this before at other conferences, that when it comes time for their lease renewal, you know, instead of doing a rent decrease or something like that, you might ask them, listen, you know, what appliance would you like upgraded? Maybe they need a new fridge. Maybe their fridge is 10 years old, 12 years old. That way you're putting money into your property and keeping your tenant happy at the same time. You know, there's little things like that you can do. You can paint a room for them, or you can, you know, you can spend money on your property and still keep the rents in market rents and keep your tenants happy that way as well. So, but you know, to add that too, Edmonton, I do believe, is a great market for investment right now. You know, we're having some tenants buy properties, and you know, they're buying in complexes. They're paying $100,000 where back in 2007 we spent 212 for the same property. You know, so there's some great deals, and the market's going to go back up. It's just a matter of time, right? So.
Yeah, I think that's a really great point. I mean, we're talking about attracting tenants versus holding on to tenants, and you know, Tyler, is it safe to say that the cost of keeping a good tenant is always less than the cost of trying to get a new one?
Oh, absolutely. You know, you just take 1 month of vacancy. You know, that's probably 2 appliances. You know, so if you can buy 1 appliance and keep your tenant a little bit more happy, you know, you're adding value to your own property for when you sell it. You're keeping your tenant happy, and you're not taking a vacancy. You know, that's what it's all about.
I like it. And Keaton, let's get into the next perspective, which is from the mortgage perspective. We're talking about like what's the right move over the next 6 months. So, you know, think about mortgage renewals or getting new properties, refinancing. What are some of the advanced strategies that you can do with your portfolio of loans heading into the next phase to take advantage of this awesome low interest environment?
So the biggest thing that we've been doing to really prep clients is, one, for investment properties that they've got and their residents, is getting them into products with more flexibility. So often that means going variable as opposed to fixed. That way, if you do get an unsolicited offer, you are in a position to play with it. Perfect example is a client with about a $400,000 mortgage right now. It's a fixed product they took in the last 3 years. They're likely looking at anywhere from $25,000 to $45,000 for the penalty. So, you know, on say a $500,000 to $600,000 property, that's a significant piece of what you might sell it for. We've been doing a lot of setting clients up with the Smith maneuver, so that way they're able to capture their principal pay down and convert that into equity they can access instantly to set them up for investing. And a lot of it's been about min-maxing portfolios to get people in a position to qualify, because the banks have been getting a little bit stickier. That doesn't mean they're not lending, but it means they are getting a little bit pickier and the policies are a little bit tighter. So we've been doing a lot of complete overhauls in clients' portfolios. And, you know, if we can free up cash flow, that's good for everyone. It gives you some safety and stability to move forward. But more importantly, it also improves your ability to qualify on other properties, so you can pull the trigger when you come across the right deal.
Those are really great tips, Keaton. And it's important to be mindful of, you know, just utilizing this lending environment. Like, you know, you made a great comment that when the interest rates are low, it means the economy's in rough shape. But if you just sit around pouting about the economy, you're not going to take advantage of the positives that has to offer. So I really appreciate those strategies. Now, I'm going to ask a question that's going to be a little bit trickier to answer, because as experts, we often try to give really general advice that applies to everybody. But I want to get the goods on where you guys are coming from. And so the question I have is, from your own personal portfolio, what kind of a deal are you keeping an eye out for during the next phase of COVID? And why is that the kind of deal you want to approach? Tyler, I'll start with you.
Can you repeat that question there, James?
I said, over the next phase of COVID, for your personal portfolio, what kind of a deal are you keeping your eyes out for? And why are you personally keeping an eye out for that type of deal?
I'd probably say that the types of property that we're looking for would be strong cash flow property that's easy to get into. So that might be an agreement for sale. But it has to be sort of rent ready. It probably is a unicorn, but you want to be nicer than everybody else on the block. That's sort of the ideal property that we want to rent personally, because you don't have problems renting it after that. People walk into it, they're impressed with it, and you only have to show it a couple times and it rents. That's the ideal property. Now, if you can get that property easily with little money, that's ideal. I think that's what everybody strives for.
Well, and I really appreciate that comment, because it is a bit of a common theme. What you described is, just what Ralph said, which is a property that you want to hold on to forever. It's easy to rent, and it makes for more stable cash flow. The other piece that, I heard you say is that you're looking for those low money down opportunities, those agreement for sales. And just thinking back to, what we're hearing Keaton talk about is there's a cycle in place where, like, foreclosures don't just happen at the blink of an eye. It's not like the second the first round of mortgage deferrals runs out in October, all of a sudden the market's going to get flooded with foreclosures. There's a timeline, there's a time lag, there's a process. And so over the next phase, there is going to be a lot of opportunity to snag agreement for sale deals, especially I think in a market like Edmonton where people don't have an equity buffer. But, Ralph, just being a Vancouver local, I'm going to swing to you. Are you thinking that there's going to be agreement for sale opportunity, or are you keeping an eye out for a different kind of deal here in the Vancouver market? What do you have your eyes open for? I know you've kind of talked a little bit about those cap rates, but if a unicorn, describe your unicorn deal that you think might actually become a reality in this upcoming market.
I think there's more potential down in Seattle. Like, I think that $535,000 house got me really excited. So I'm going to go sleep in my son's basement and hunt real estate deals. I don't know. But it's just like, holy smokes. Like, it's, there's all these smart people down there. You've got Amazon, you've got Microsoft, you've got Boeing, you've got Starbucks, like Amazon, I think I already said them, but anyway, like, just these companies that are paying people big money. And Amazon, just hired another 6,000 people in downtown Vancouver, so they're being good to Vancouver too. But the thing that it all comes down to is my definition of something that's overpriced. And to me, something's overpriced that I can't hold forever. What can't you hold forever? Well, if the expenses are more than the rent coming in, that you can't sustain. So, a lot of investors are aggressive and they buy something which I call high, which still might be a great deal, but it doesn't cash flow, and they want to sell it higher. And it's just a very dangerous thing. So I don't look for unicorns like that. I look for things like, I mentioned the building on East Hastings. We bought it for 2.7, and a year later we had it appraised for 5.4 million. So that's a pretty good deal, and it was all because it cash flowed. And, we recognized the cash flow, we reperformed it, and, the owner was asleep at the wheel. So that's my unicorns. When an owner is asleep at the wheel, it might not cash flow when I buy it, but damn well it'll cash flow after I get a good property manager in there and get their teeth into it.
I love it. And I think we're going to see a lot of owners who are just down and out because of the stress of making it through the first part of COVID. So, they might be asleep, not necessarily for lazy reasons, but just asleep because the pressure of getting through this has just tuckered them out.
And they have an agenda. Like in Sarnia, the people that sold us this building were retiring, and they just wanted a easy mortgage. They gave us an 80% loan to value vendor take back mortgage, and they can retire. And COVID helped us because they were like, we can't ask as aggressive a price as I was hoping. Ralph's the lifeline. Thank you, Ralph. So
that's awesome.
Yeah, it's a win-win.
And Dave, what is your perfect deal? What are you keeping your eyes out for? What do you think is going to be possible heading into phase 2 of COVID?
James, my perfect deal is one that somebody else is putting together, because years ago I realized I suck at dealing with tenants and toilets. So these days I focus on partnering up with smart guys, typically clients of mine that I know quite well. And I'm more of the passive investor. And what I'm looking for, just like Ralph is talking about, I'm into buying something, holding on to it long term, prefer multifamily properties if possible, and looking for an upside, whether that's forced depreciation, whether that's, underperforming properties, bringing up the rents, or whether that's forcing up the value of the property by doing something creative like creating furnished rentals, not necessarily Airbnb these days, but medium to long term furnished rentals, those sort of things where you can really, again, kick up the cash flow. So my focus is finding people that have their nose to the ground and partnering up with them.
You had some good luck in Ontario, Dave. You kind of
did.
led the way. I followed you.
That's awesome.
You're taking it to the next
Ontario's
level.
cheap.
All right, we'll hand it off to Keaton, and because I know, Keaton, you've been checking deals out for the last couple of years now. Keaton actually picked up a couple of great properties in Edmonton. And Keaton, what's your dream deal? What do you think is going to pop up in the marketplace in this phase 2 of COVID? And what are you cautiously keeping an eye out for? What are you pursuing?
Well, the biggest thing that we've always looked for is kind of long-term. It's, for me, real estate's a retirement strategy. And as Ralph once said, there's squirrels and acorns in the world. And if you look for squirrels, you'll see squirrels. If you look for acorns, you'll see acorns. So I really believe that there's going to be some ups and downs over the next 6 months to a year, maybe 2 years. And when those downs happen, people are going to freak out. People are going to, they're going to close off and they're going to panic. And I think the investors that keep their eyes open and keep engaging with people and having discussions are going to come across deals. And realistically, that's what I'm looking for, is when someone starts to get nervous and thinks that, oh my God, real estate in the next 3 months is terrible. Well, sure, maybe. But real estate in the next 3 years or 6 years or 10 years is still always, in my opinion, always going to be a winner, especially with all the money being printed and the inflation that's going to come. So really, it's just about decent, strong cash flowing deals with long-term potential, maybe subdivision potential, maybe the ability to, convert a fourplex into 2 duplexes, stratify the title, or break off into 2 lots and sell. Like, those are kind of things that I've been looking for and I will continue to look for. Slow is steady, steady is fast. That's my philosophy and I'm sticking to it. So.
Can I add to my quote?
Yeah, please do.
I also said,
I won't mention who you said that quote about.
There are more acorns than squirrels to eat them. Like, there's deals out there, folks, and you just got to get out there and look, and don't be worried. We live in a world of abundance, not a world of scarcity. And you just have to open your mind to what a good deal is and get good at recognizing a good deal and focus on just a few markets, not a lot of markets, so that you become really, really good at those markets. Or else, I agree with Dave, get somebody like James that knows what he's doing, and we just give them money and they make us rich. I like that method, Dave. I've got a new acorn to look for.
I love it. Well, Ralph, I think that was a great parting thought, and we're just about to wrap up the panel. So what I'm going to do for the last 3 is I'm going to turn that into a really great question, which is, what is your kind of parting thought? We've had a lot of really great conversations about what we're seeing, what we should do about it, what strategies make sense. But for the investor that's just keeping an eye out and, you're in that elevator and somebody says, oh my gosh, Tyler, I recognize you. You're the world famous property manager from Edmonton. What's your piece of advice for them in that quick second of conversation when you're chatting with somebody?
James, I think it's always just comes down to the fundamentals. You make your profit when you buy the property. And if you buy the property properly, you can't go wrong. It's if you buy something for a long-term hold, it's a good property. And you may sell it short-term if you get the right price, but there's no harm in holding it long-term because you bought it right.
That's awesome. And Dave, what's your parting thought?
Well, I'm biased because I'm a marketer, James. So my advice is good times, bad times, never stop the machine. And what by that I mean, never stop whatever it is that you're doing to find deals. Keep that chugging, even if you think, there are no good deals out there. Like Ralph said, there's always lots of acorns out there. You just got to be always on the look for them. So don't be lazy about that. And also, if you're going to be using other people's money, if you're going to be bringing on investors to help you buy these properties, never stop raising capital. That needs to be something that you're consistently always doing, because once you stop either one of those activities, getting restarted is a huge effort. It's so much easier to keep the ball rolling than to start it in the first place.
Dave, I'm just going to piggyback off that, because I share your philosophy as a marketing guy myself. And, whether you're working your joint venture machine to try to find joint venture partners, whether you're working on finding great deals, or, even just for the realtors that I work with on my team, whether you're looking for real estate clients, you always want to keep your momentum going by consistently putting a little bit of effort into those marketing activities every single week. It's the power of that habit. So I really think that's an awesome point, is that if you want to be in the business of the real estate business, consistently doing the right things every week is going to keep every week, every month is going to keep your business really strong. Keaton, what's your parting thought from the mortgage world?
Well, I think this applies to everything really, and that's stay connected. If you're new to this, talk to as many people as you can. You'll notice that the same names keep coming up over and over and over, whether it's good things or bad things. And the more connected you are, I really do believe it's Ralph's secret. I don't think I've ever seen Ralph silent for more than 30 seconds in a room. He can't help himself. And is just connect with people. The more people you talk to, the more opportunities you may come across, the more things you may learn, the more secrets or tricks or tips or people that can help you, whether it's finding a new broker or a realtor, whatever you need. So really, at the end of the day, stay connected.
Love that piece of advice. Yeah, and I mean that's why we're easing back into these events, because your network really is your net worth, and if you take the time to connect with people, that's where opportunities, ideas, and inspirations keep coming from. So, great advice, Keaton. And this parting thought, I'm calling it the Ralph Case Challenge, because if you can deliver your parting thought in under a minute, then I think we'll all be impressed, Ralph.
Okay, so my parting thought is get into clarity and get into confidence. So you want clarity of what you're looking for, clarity where it's going to be, and clarity of what a good deal is. And then you have to have confidence to get out there and write the offer, to tie it up, to get your joint venture partners, be enthusiastic about it. And that's how this world works. Like, if you don't have clarity and confidence, just work towards it. We don't start out with that. It takes writing offers. It takes getting, some speed bumps and getting some hard knocks. But that's important. And my favorite quote is, luck occurs when preparation meets opportunity. So all the preparation and knowledge about real estate won't do you any good unless you're out finding those acorns. And finding those acorns won't do you any good if you don't know what the hell you're doing. So you got to do a little bit of preparation, education. Dave has some fabulous stuff as far as real estate education goes. I had the education of hard knocks, but I pretty much know what I'm doing now after 40 years of real estate investing. But man, we've all had some tough times, but just keep on persevering until you get better and better and better. And anything worth doing is worth doing poorly until you learn how to do it well. That's my theory. So I gave you 3 for the price of 1.
I like the hat trick, Ralph. So, Adrian, I'll get you to kind of approach the stage so you can introduce the networking break. We're gonna do it. We're gonna network. It's gonna be awesome. So big thanks to all of our panelists. So for all the participants online, you can use the little emoticon to give them a little clap and a high five. And everybody in Edmonton and Vancouver, this is the first round of applause you've probably given to a speaker in a while. So let's really celebrate them and thank them for putting in the effort.